So Octavio had asked me, can you share your opinion regarding this transaction? Apple at $155 per share. Low cost, shorter term downside protection. Buy two 148 puts at 216 for August 5th expiration and sell one. I'm sorry, I'm going to go back to something real quick, Octavio. And sell one 155 put at 445. I wanted to show you this real quick. So this was a straight ratio call spread where we're buying 2 and selling 4. And if you did that by itself, it's a pretty risky transaction. Meaning that, yeah, you've got some good downside here, but you're short twice as many calls as you're long. So you're naked 2 calls, so you have infinite risk to the upside. What Octavio is talking about is a back ratio put spread where I'm buying 2 lower strike puts, but I'm going to fund the purchase of those 2 lower strike puts by selling a right at the money higher premium put on the position. So essentially, what do we have? Well, let's take a look. We've got it entered here into the portfolio. Okay, and sorry, it doesn't show me the unlimited upside as much as I'd want. I apologize for that. Oh, sorry, folks, bumped the microphone. All right, so out to August 5th, what have we done here? We have shares of stock. We bought 2 lower strike 148 puts, and we sold an August 155 put against it. So again, like I broke down the other position, what we effectively have here is a married put position to August 5th expiration. 148 strike put at 216 against 155 shares of stock, combined with a $2 extra kick for profit in a bull put credit spread by selling the 155 and buying a 148, a 7-point spread, in this case with a $2.30 profit just on that leg. Okay, now, where's this $700 come from? Because of this, the short put to the long put. It is covering it, but it's still a bull put, so you've got to put up the extra margin. And of course, your cost basis here at $15.4087. You've got about 10 cents. Okay, 13 cents, $13 of positive premium, Octavio. And of course, the maximum risk is $13.87 or 8.6%. Let me jot that down. So it's an extra $700 for a risk of 1,387, 8.6%. BE of 154.94. Okay. Want to do something real quick before we jump back into this. And what I want to do is just take out the stock. So normally when we talk about ratio back spread positions, this is what we're looking for. By itself, without the stock, just like if I bought a long put, for example, you buy a long put, you have a cost, and as the stock continues to move down, you've got infinite profit on the bought put position until the stock hits 0. Similar to what we're looking at here. But instead of buying a 1-for-1, which is 148 put at 216, where in that case, my break even would be 145.84. I think it was 216, so it'd be 145.84 would be the break even. Here, my lower break even's down to 141.13 in this structure, not including the stock. The allure of this is that it is, as Octavio mentioned, a lower cost repair. I'm actually getting paid 13 cents, but against the stock position, in this case, I don't have a capped upside. It's still infinite upside. Investors trade this sometimes if they're bearish, because if they're wrong, they still want to see some profit to the upside, whether it's $10, $13, $14, $15, while still having that potential to make money. But the ratio back spread sometimes gets you caught in this death valley area. Okay, now I'm not, Octavia's not even asking about that. I just want to show what the ratio back spread is. It is sometimes considered a lower cost, shorter term protection than just buying the put against it. Let's add our stock back in at 155. Take a look at those numbers one more time. Because we're getting a 13-cent net credit, we lower the break even on this position slightly. It would help if I put in 100 shares, wouldn't it? That's great. All right, much better. So we lower the break even down by a little bit because of the 13-cent net credit that we take in, but the bull put credit spread would also be losing money if the stock was here. That's why it's not 13 cents down, because I'd be losing on the stock structure and the new cost basis I have on the stock with a 13-cent net credit, but the bull put would also be losing too. That short put would also be at a loss. So that's why the break even's not at 154.87 that you'd expect. It's at 154.94. However, we still have infinite upside, and that's great. We've got a risk of 8.6%, and we got a small credit, but we have to put up the margin requirement to do it. So we're technically still adding, if I take off the credit, we're still adding 687 into this position for this value. Now, better or worse, it's probably going to be worse, but if I just buy, one short-term married put position at 216, I'm paying 216 out, which affects my break even up to 157.16. But now I've got a risk of only 5.8% instead of 8.6%. Everything's a trade-off, Octavio, isn't it? I increase my break even because I didn't take in a credit. Octavio's approach using some investors will actually use the ratio put back spread, or sometimes just the bull put, bear put debit spread, as a hedge, with a deep out of the money put and a right out of the money put, so they're not paying as much for it to hedge the loss on the stock position while leaving the upside open. By adding the cost and not having to add the extra margin requirement, I do take less risk if the stock is below 148. It's only 5.8% compared to 8.6, but I increase my break even by 216. Now, I could lower that as well. We were August 5th, correct? 14 days out. Where's a risk of 8.6? I think it's here at 146. I think that's what I'm looking at. Oh, sorry, folks. Oh, 6.9, I'm sorry. Yeah, so I could even go lower. I could go down to the 144 put and only increase the cost by a little bit and still have the same risk of 8.6%, which didn't fully trigger in until the stock dropped below, say, 144, maybe even 143. Let's try 143. That's a jump of only 1%. I'll try 142. In any case. It should have been 143. Okay, but anyway, here in this situation, if I bought the 142 put and add $1.20, yes, my break even's at 156.20 versus 154.94 with the stock plus the ratio put back spread structure. The stock falls below 148, I lose the full 8.6%. If I just bought the married put, say at the 148 strike, and it fell below 148, I'd only be at a loss of 5.6%, but it increased the break even. And if I buy a lower strike put and only add $120 in instead of that 216 cost, well, I'm still about that 8.8, 9% risk. It's 9.1, probably the 143. And yes, I still did increase the cost basis, but if the stock fell to 148 in this scenario with the lower strike put, even though we didn't receive it as a credit, we're down 819. Oh, that is the full loss. Oh, no, we're only down 819 at 148. We haven't reached the full loss on the position of 9.1%. We're $500 less in this loss case scenario than the $1,387 it was on your ratio put back spread if the stock was trading at 148. So I'm just running these numbers as a comparison. When I look at the ratio put back spread, I get the idea behind it. You see a cost to buy a put, even if you're using a shorter term for protection, 2 or 3 weeks out in time, maybe to cross an earnings. I'm not sure when Apple's earnings are, if they've already, I haven't checked. 728, there you go. So crossing earnings here with protection in place, even with the known event coming up in this scenario. If I buy a cheaper put and just add a little bit to it and the stock fell to 148, we're only losing 819 on the position, and we didn't have to put up the $700 margin requirement to do it. We're not near the full loss yet. Whereas on our ratio back spread position, let me get back to that. If the stock's at 148 on expiration, where are we? Full loss of 1387 on the position, or 8.6%. Is it worth it to increase the risk, even though you're buying two and you've got that strong downside that we're looking at? And I think, in this case, is it worth it if you're wrong and the stock falls to 150 here and you're taking $1,000 loss, then maybe just buying a cheaper put without having the extra bull put credit spread in play if you're wrong, to where you still have unlimited upside. You only maybe added $1.20 or $1.50 to the cost basis, increase the break even by $1, $1.50, where you'd still only be losing $600, $700, or $800 if the stock was below 148. And yes, you could still lose that $1,300 if the stock was below 143 or 142. Absolutely. But you'd be losing less than you would be on the ratio put back spread, because you're still going to be losing on this put in no man's land. The short put that you sold and the stock in this no man's land area, you're still sort of losing on both. And that's why it's much higher, because you've got that $700 extra margin there. Is it worth it for the 6 cents of lower break even? It's hard to say. Does it still give you coverage in case of an uncertainty? If Apple falls to 125 or 140, yeah, you're going to be much happier that you have something in place, even this. Absolutely, Octavio. But looking at those other structures, is it worth it to take on an extra $400 or $500 risk with that ratio put back spread than just buying a cheaper put that's maybe further out of the money that, yes, risks a lot? Let's do the 143. I think that's going to be about even. Sorry to keep flipping there, folks. I'm just trying to eyeball it here. And there we go. Perfect. God, that's perfect. So it's the same risk, but in order to get the maximum risk of 8.6%, the stock has to fall below 143. Okay? Absolutely. If the stock, in your example, the stock hit 148 on the expiration, be a loss of that same $1,340, $1,335, or 8.6%. With this cheaper put, you're only down $779, a little bit more than half of that position. And, sorry, I just lost my train of thought. I'm sorry. So in that case there, where you'd be at the full 8.6% loss in the other one. Yes, you could still lose 8.6% here, but it would have to fall much further. Octavio says, you like the married put better. Well, as an earnings play, I see the, maybe you're not, how do I want to say this? Maybe the structure isn't the best. Okay, there are a lot of investors I know who use these put ratio back spreads, but maybe you want something that's a little further out of the money if you can still get a credit on it to help you with the break even. But you know me, when I talk about a married put, I'm usually always likely to play a married put even around earnings. You know I'm going out expensive. I'm paying a big price December. We're at 155 now, so let me use the 165 strike. If I bought it at 155, it's at 154 now, so if I bought it at 155, 165. Okay, I could have gone to the 160. That would have been a much lower risk. I'm sorry, it would have been a higher risk, but it would have been the target. This is too low. I'm going to say this is too low, Octavio. Following, again, the rules in the blueprint, Apple does have that lower volatility. January or December. January's fine. More than fine. It's probably preferred at 182. Could go further out as well, but I want to use the 160. Why pay $15.80 for a put in this position? I have a 6.3% risk, which is less than the 8.6% on the ratio put back spread, and is less than the 8.6% using that cheaper 143 put. But remember the proper structure that follows the three core principles, the time value decay curve. You know, this is 150 days out. And you buy an option that's 150 days. This is 120. I know it's not a clean drawing. Sorry, folks. This is 90. And yeah, not smooth enough. It's more like that. There we go. Okay, so here we're talking about 30. This is the cusp of 60, or sometimes 90. This is 90. And so on and so forth. This is 150 days out in time. Okay. Also the fact of the ATM bell curve, which you did well on. right? So the ATM bell curve, this is why I'm buying in the money, because the option that's closest to the current stock price always has the highest time value, which equates to the maximum risk in a married put structure. That's why I'm going slightly in the money here for that controlled risk of 6.3%. You bought your puts, Octavio, down in this range, 148. Yeah, close, but yeah, pretty much down here, even to this range. So that's good. You're following the ATM bell curve because you sold here right at 155 at the money, and you bought two lower strike ones on the lower end of the at the money bell curve. So you're following that principle. But why is this time value decay? What we're talking about here is how much time value you expect. If I buy 150 days out, in the next 30 to 60 days, it's going to be much slower time decay than if I bought it 60 or 30. That's why I'm paying that higher price. But I'm only paying into $10.80 of time premium. That's my risk. And that's in the worst case scenario at January expiration. If I hold the stock all the way to January expiration, make no adjustments on the position following the rules in the blueprint for the married put structure, the proper married put structure, and accept no dividends. But we go to August 5th, and in a worst case scenario, our stock fell to 148, where we were at full loss of 1,387 or 8.6% on the ratio back spread. We saw a loss about 770 on that 143 put if the stock fell to 148, and we'd only be down $436 on this position if the stock fell to 148 on August 5th. A third of the loss we take on the ratio put back spread, but you got 13 cents on the ratio put back spread. I'm adding 1580 to this position. So you can argue, my God, Mike, your break even's at 170.80. That's at January expiration, assuming no adjustments are done on the position. Tomorrow, if the stock moves up, Monday, if the stock moves up $1, I'm on a positive 50 cents, 40 cents on this position. Tomorrow, the next week, the next 10 days, my break even is just 1 or 2 points above where the stock is, because my put only has a delta of, say, 0.55 or 0.6. So for every dollar the stock moves up, I'm only losing 50, 55 cents on my put option. I'm still gaining positive delta on the scenario. This is the worst case scenario. It's not tomorrow. It's not on August 5th. It's not on the 28th after the earnings come out. Yes, my put's going to decay as the stock moves up, but I'm always going to make more on the stock than I'm going to lose on the proper structured put. So 728 we said, right? That's the earnings. Let's go to 729. And let's say the stock we're at 154 now. Let's say Apple has a good move, 11 points up to 165. I'm still going to be profitable of about $500, okay? 479 in this case. Yeah, so the stock, I lost a little bit more than 50% because I probably have 0.55 delta on my put. I lose 55 cents on the put for every dollar the stock moves up. So we moved up. Oh, I'm sorry. My cost basis was 155. I was going to put it 166. That's okay. That's perfectly fine. Whereas, where would your ratio put spread be? You'd be up 10.06. That's true. I'm only up 400 here, but I still have protection out to January, where your protection runs out in 7 days on August 5th. Excuse me. Pros and cons, Octavio. I prefer the married put. Why? Because, well, I've been teaching it, trading it, mentioning it, dissecting it for 14 years now, since 2008. I know it essentially inside out. I know what to expect when the stock moves. I know what to expect what I do in income method. What income method I look for as the stock fluctuates up and down in price. The put ratio back spread is not too bad of an idea, don't get me wrong. You still get all of the upside as you would if you had just bought the stock with no protection. At least you have some protection in place from the unexpected. And you got a little hedge. That's great. But again, as we saw, maybe just buying a straight cheap put on this would have a lower risk in the case if the stock hit your final point here at 148, your pivot point. And buying the 143 or 142 at 148, it was a little bit, $700 loss or something along those lines. With the true married put position out to January, is only a $400 loss because I'm keeping 90% of the time value that I did to buy in that position as well. Okay. All right. Octavio says, my initial idea was to use the 2-to-1 times to get the stock to bulletproof. That's going to be tough because you're only taking in 13 cents at a time. And if the stock stays below 155, you're going to get put the stock, but you're not really averaging down, right? And if my cost basis was 155, and I'm selling the 155 put and the stock's at 149, these two puts expire worthless, and I buy another 100 shares of stock at 155. I'd rather buy them at 149 at this lower level to average down if that was my plan. Getting 13 cents at a time here, 12, 13 cents at a time, it's going to take you a long time, I think, to get the position bulletproof with the ratio put back spread. And because you're doing it, again, it's not like an income method number 12. An income method number 12 where I sort of create a synthetic straddle or a synthetic strangle because I have two puts against 100 shares of stock. You have a bull put credit spread that you could lose on that $700 margin requirement here. And you've got just the married put position. So it's not a position where you have more long puts than obligation on stock. This put here is covering this as a bull put. This put here is covering the stock position. So you don't have a V where if the stock goes to zero, this has extended profit. That only does that in the case of a ratio put back spread without the stock itself. Okay. It's not infinite protection like the strangle or straddle here with income method number 12, having two puts to 100 shares of stock. The true ratio back spread, yes, gives us this profit and loss chart, but when you add the stock, you've got the bull put with the married put, which we're seeing down below. And again, last time, I get the value of it. You want a lower cost. You're getting a little bit of credit that actually lowers your break even. But now you've got an obligation here. Remember that. Rights and obligations. Talked about at the beginning of the presentation. Anytime you're entering a new strategy, make sure you're well aware of all the rights and obligations and outcomes and ins and outs of the particular strategy. Because if the stock's trading here at 150 or 149, your 148 puts expire worthless. You've either got to buy back the 155 put you sold here or buy another 100 shares, which it's at the same price. You didn't really help average down. And maybe you could say your cost based on the new shares is 154.87, that extra 13 cents you got. But again, it's not really effectively averaging down to get towards more of a bulletproof status. Now, if you had a January married put to begin with, and you're doing this in the shorter term as extra protection as a hedge, again, that's a whole different story. That's doing what I suggested. I don't think it's going to look right. But if, Octavio, you were already in a married put position and you're doing this in addition to that, so we'll go back to our January 160 put that had the 6.1, 6.3% risk. And so here, yeah, you have that extra kick if you're already in a married put and do the ratio put back spread, but now you see the risk of no man's land. Dead man's valley is what we call it with things as reverse butterflies or these ratio put back spreads. Your lower break even is down to 131.82. And it's got to go a long ways for that extra insurance. Yeah, true. I mean, if it falls down here to 135, you're still happy because you're only losing $200. The stock's down 20 points, right? But that's how this looks with a married put. With just the stock itself, you don't get that extra benefit of having an extra put because one put in the ratio put back spread is covering the stock. The other is covering the short put. You have a bull put and a small short-term married put position with a higher risk of that 8.69% or so in those cases. Okay. So that's my thoughts regarding that, Octavio. I do know we have had discussions in the past of using a bear put debit spread as a hedge against the stock position for a cheap way to do it instead of just buying the put around earnings or something along those lines, using the ratio put back spread or other things. But I don't know if it's the best risk control. It has the best cost effectiveness. I think I'm going to say that, Octavio. Obviously, we proved that. But for the risk level, if it doesn't do what you want and it goes against you, I'm not sure if that's the best play. If it does what you want and the earnings are great and it goes up to 165, 170, that put ratio back spread, little net credit as a hedge against the position would work out pretty well. And it give you the best return to the upside as we saw. I would only make $497 with the preferred married put discussed in the blueprint and the radioactive trading techniques. We saw that was a 497 profit if the stock went up to 165 after earnings, whereas the profit was closer to was 1,100, I think, on the other one with the ratio put back spread. With $1,100 based on the cost base, a little bit more than that. And on the standard cheap married put, it would only be about 960 because we paid that $140 or so for the put, the 143 put. So if it moves up to 165, we're making about $900 because we have a break even about 156.20. The put expires, but we've added to the cost basis. So pros and cons. Every strategy there, the benefits of the pros and cons. That's what you want to look at and evaluate. So Octavio says, thank you. You're a great communicator. I'm glad you followed that discussion well, Octavio, and it made sense to you. So again, not a bad approach. Investors will use it. And sometimes maybe it's better just to keep it simple and buy a cheap put if you're going into earnings and you're planning on holding Apple for a long term and do other strategies against it as well.